Hello everyone, Luke McElfresh here. In today's video, we continue with our discussion on how firms evaluate capital budgeting projects. So in Chapter 9, we talked about the different methods that companies will use when they're evaluating capital budgeting projects, and these methods include net present value, payback period, internal rate of return, modified internal rate of return, and also the profitability index. And then in Chapter 10, we went one step further and took project scenarios and actually projected what the project cash flows were. Now in Chapter 11, we deal with these cash flow projections and understand that these cash flow projections are just estimates. So we have what is called forecasting risk. So forecasting risk is the concern that a project will be accepted or rejected incorrectly due to incorrect projections and what their cash flow estimates are. So there are two main types of scenarios or analyses that are conducted in this chapter. One is a scenario analysis, which asks what-if questions. So basically what we have is a base case, which is our initial projections, and then we run a best-case scenario and a worst-case scenario. And then our second type of analysis would be a sensitivity analysis, which is when you change one input and see how sensitive your net present value is to changes in that one particular input. So for the two problems that I have here, we run the scenario analysis where we have a best case and a worst case and a base case scenario, and we look at what the net present value is, or we look at what the cash flows are, and eventually the net present value under these different scenarios. So as you can see in this first problem, Jabroni Incorporated, we have all of our base case information of 12,500 units being sold, what the variable cost per unit is, the fixed costs, and also what our sales price and depreciation, all these different values that are the base case for this particular project. But then we have a range as to what these values could fall within given a best case or a worst case scenario. So in this problem, what's key is it's asking what is the earnings before interest and taxes under the worst case scenario. In a worst case scenario, ask yourself what would have to happen if this is the worst thing that could happen in this particular project. So in a worst case scenario, what you have is the lowest sales. Worst case scenario, you have the lowest amount of sales, but in addition to the lowest amount of sales, you would also have the highest costs. So they give us what the base inputs would be, and then we need to calculate what the upper or lower limits are of these different inputs based on whether or not we're calculating a worst case or a best case scenario. So in this problem, with them asking us for the worst case scenario, we need to calculate what the lowest sales would be. So here in our worst case scenario, the number of units being sold, our base case was 12,500 units, but we have a range of plus or minus 2%. Under a worst case scenario, we would go down 2%. So if I want to figure out what my new units sold would be, I'm going to multiply the base number of 12,500 by 0.98, a 2% reduction, so 98% of the initial 12,500 unit projection, and I would find out that my units sold in a worst case scenario is 12,250 units. Now, not only are we selling a smaller amount of units or a lower number of units in our worst case scenario, we're also receiving the lowest price. So when I look at price here, they say that it would have a sales price of $69 a unit plus or minus 3%. So base case is $69, but if it's a worst case scenario, I would actually only receive 97% of that since it's plus or minus 3%. So I'm going to take my initial base case of $69 and multiply it by 0.97. And my costs or my price per unit under a worst case scenario would be $66.93. So that would equate to the lowest amount of sales. Now we deal with our costs. Variable costs, worst case scenario, would be as high as possible. Our variable costs are $13 plus or minus 2%. So I'm going to take $13 and multiply it by 1.02. So an increase of 2%, that's 102% of $13. And my new variable cost per unit would be $13.26. And then we also have one other cost, which would be our fixed costs. Fixed costs also would be highest under a worst case scenario. Our fixed costs are $237,000 plus or minus 1%. So hopefully you're catching on here that it would be $237,000. Worst case scenario would be an increase of 1%. So multiplying it by 1.01 will give me that 1% increase. So my fixed costs under a worst case scenario would be $239,000 $370. So all I've done right now is figure out what the worst case values would be based on these different ranges that are provided for each of my inputs. Now the question is asking, what is my earnings before interest and taxes? So they are looking for my operating income on my income statement. This is going back to our discussion on income statement, where we understand that our top line figure on our income statement is sales. In this case, to figure out what our sales amount would be under a worst case scenario, I'm going to take the lowest number of units being sold, so 12,250, that's what I calculated previously, multiplied by the lowest price per unit, which is $66.93. And I would find that my sales amount under this worst case scenario would be $819,892.50. Then let's go ahead and calculate the variable costs. Variable costs on the 12,250 units that I'm selling in this worst case scenario, multiplying that by the highest variable cost I calculated earlier, which would be $13.26. My variable cost under this worst case scenario would be $162,435. Then I've already calculated what the fixed cost would be underneath this worst case scenario, and that was the $239,370. So the 1% increase from the base case values that they provided. And then if you remember from our discussion on the income statement, to get to your operating income, it is sales minus costs minus your non-cash expense of depreciation. So I still need to deduct depreciation here on my income statement. And that depreciation base case value is $68,000. Notice that we don't have a best case, worst case on that value. We know what that depreciation amount is. And so then I'll get to my EBIT, which is your operating income, by just making these deductions from my top line figure of sales, and I would get an operating income, or an EBIT, of $350,087.50. Now you could solve for the EBIT under the other two scenarios as well. Base case scenario, if it was a base case value, or they asked what the base case EBIT would be, the values that you would use on this pro forma income statement, which remember is just a projected income statement, would be the initial values. So no adjustments for best case, worst case. If it was a best case question, you would have the if it was the best case scenario, you would have the highest amount of sales and the lowest amount of costs. So with the scenario analysis, all good values go together. So by good values, I mean highest sales, lowest costs. In a worst case scenario, all the bad values go together: lowest sales, highest costs. So that's one way that companies can improve the possibility of, or decrease, I should say, the amount of forecasting risk. Making the incorrect go or no-go decision is by conducting a scenario analysis and running three cases: base case, best case, worst case. If you have a positive net present value underneath all three scenarios, you would imagine that that project would add value to. So in this next problem, we combine information from the last three chapters. So as you can read here, we are evaluating a project that costs $788,400, has a 9-year life, no salvage value, and then they give us our base case input: 75,000 units per year, $52 per unit, variable cost of $36, fixed cost of $750,000. We have our tax rate, we know what our required rate of return is, and then we have upper and lower bounds on each of our inputs. So saying that each of these inputs are accurate to within plus or minus 15%, and they want us to calculate the best case and the worst case net present value in these two different scenarios. Before we can calculate net present value, we need to know what the cash flows are. We have our inputs to be able to calculate base case cash flows, but they're only asking for what is the best case and the worst case net present value. So what I need to calculate is what is the best case cash flows for years 1 through 9, and what are the worst case cash flows for years 1 through 9. So I'll start off by doing a best case scenario. So as I mentioned in the previous problem, with a best case scenario, all good inputs go together. So we have the highest amount of sales, highest price per unit being sold, and then we also have the lowest costs. So we'll start off with identifying the amount that we are selling. So our initial estimates state that we will be selling 75,000 units each year. So 75,000 units, but all of our projections are accurate to plus or minus 15%. In a best case scenario, I would increase that by 15%. So if I multiply this by 115% or 1.15, my best case scenario for number of units sold will be 86,250 units. Now let's calculate the price per unit underneath this best case scenario. The base case price is $52 per unit, but this is accurate within plus or minus 15%. Underneath a best case scenario, I would receive the highest price, so I'm going to multiply this by 1.15, a 15% increase. And underneath this best case scenario, I would be able to sell each of these units for $59.80. Now let's calculate the costs. Variable costs underneath a best case scenario would be the lowest amount. Our variable cost per unit is $36, so $36 in this best case scenario would be the lowest amount, so a 15% reduction. I can figure out what this 15% reduction would be by multiplying the $36 by 0.85, and my variable cost in this best case scenario would be $30.60. The other way that you could do this in a two-step manner would be taking 36 and multiplying it by 0.15 to figure out what the 15% is of that, and then subtracting it from 36, and you'll get to the $30.60. I'm just doing it in one step for simplicity purposes. And then fixed costs, my fixed cost projections, base case projection was $750,000 per year. But again, this is accurate to plus or minus 15%. Best case scenario would be the lowest fixed cost, so I multiply that by 0.85, a 15% reduction, and my fixed cost in this best case scenario would be $637,500. Now let's go ahead and just do the worst case since we have these values here. All I'm doing right now is calculating what the best case and worst case inputs will be, and then I'm going to take these inputs and calculate what the project cash flows are for years 1 through 9. So worst case scenario for quantity would be the 75,000 units base case, but underneath a worst case scenario, I would sell this for I would have the 15% reduction in this, so multiplying this by 0.85 will give me a quantity of 63,750. Price would be the initial $52, but worst case scenario, it would be a 15% reduction, so my price would be $44.20. Variable cost, worst case scenario, would be the highest amount, so 36 was my base case, multiply that by 1.15, a 15% increase, so $41.40 would be my variable cost underneath this worst case scenario. And then fixed costs underneath the worst case scenario would take the base case of $750,000 and a 15% increase, so multiplying that by 1.15 would give me a worst case scenario for fixed costs of $862,500. I saw I had a little typo over there. Okay, so these are just my pro forma inputs. I could create a pro forma income statement and calculate operating cash flow in that manner by using one of the equations for operating cash flow that were listed in Chapter 10. What I'm going to do here is I'm going to calculate operating cash flow using the tax shield approach. The tax shield approach says that operating cash flow is sales minus costs times 1 minus your tax rate. And then you add back in your depreciation tax shield, which is your depreciation times your tax rate. So let's do best case first. Calculate I'll highlight this one in red. So let's do the best case operating cash flow, where we would have sales of, I have not yet calculated sales. I need to take these inputs and actually calculate what the pro forma income statement items would be. So one step before I calculate operating cash flow, my sales is going to be the quantity that I have calculated here of 86,250 multiplied by the price in this best case scenario of $59.80, and I would end up having a sales amount in this best case scenario of $5,157,750. Let's go ahead and calculate variable costs. So once again, these values are just coming from up here. So variable cost would be the quantity of 86,250 times my variable cost per unit of $30.60. My variable cost would end up being $2,639,250. Fixed costs are just going to be that fixed cost value of $637,500, and then we have a depreciation expense that is equal to $87,600. Now, you could go ahead and take this information and calculate EBIT, and then actually calculate what your tax expense would be with that tax rate of 21%, and calculate net income. And like I said, calculate operating cash flow either using the definition of operating cash flow, EBIT plus depreciation minus taxes, or you could do the top-down approach or the bottom-up approach. What I'm going to do is, like I stated previously, the tax shield approach. So with the tax shield approach, the operating cash flow for the best case scenario, sales would be $5,157,750 minus my costs. I have two different types of costs, so I have my variable cost of $2,639,250 minus my fixed cost of $637,500. I'm going to take this value and multiply it by 1 minus the tax rate. In this case, the tax rate was 21%. This is given in your required pieces of information, or your given information. And then I'm going to add back in the depreciation tax shield. The depreciation tax shield is the amount that I save in taxes by utilizing depreciation on my income statement, and it's calculated by taking your depreciation expense of $87,600 and multiplying it by your tax rate of 21%. So what I end up getting here is, if you were to do all these calculations, and you guys can verify this answer, you get an operating cash flow in a best case scenario of $1,504,386. And this is going to be an operating cash flow for years 1 through 9. So we don't have any increases or decreases in any of our inputs. We just have a range of upper limits and lower limits for each of our inputs, which is what we use to get our best case scenario. But our operating cash flow will stay the same for each of the years of this project. Let's go ahead and move forward and just go ahead and do the worst case scenario as well. I'll go ahead and do this one in blue. So again, I will use the tax shield approach. Before I use the tax shield approach, let's go ahead and calculate what our sales figure would be in this worst case scenario. Worst case number of units was 63,750 units at the lowest price possible of $44.20. Worst case scenario, our sales figure would be 2,817,750. Now let's calculate our variable costs and our fixed costs under each of these scenarios. Variable cost would be the 63,750 units, the lowest possible units, multiplied by the highest variable cost, $41.40. I would have variable costs equal to 2,639,250. And then I have my fixed cost, which is what we already calculated to be $862,500, and the depreciation amount does not change. That was given in our information. Depreciation is still the $87,600. So once again, I could take this one step further and calculate what the EBIT is, your earnings before interest and taxes, and then pay taxes, and then get to my net income, and that would be my pro forma income statement, and I could calculate operating cash flow using any of the 4 equations that were presented in Chapter 10. The equation that I would like to utilize once again is our tax shield approach, which says you take sales minus cost, which is the 2,817,750 in sales, minus variable cost of 2,639,250, minus our fixed cost of 862,500. And I multiply this sales minus cost by 1 minus the tax rate of 0.21%. And then I add back in the depreciation tax shield, which is $87,600, your depreciation expense, times your tax rate, which is 21%. And when I do these calculations, you would realize that you would have an operating cash flow here that is equal to negative $521,964. And once again, this is the operating cash flow for years 1 through 9. It does not fluctuate. So now what we have done in this scenario is we know what our initial startup is, or our initial cost to start the project. The initial cost to start the project is $788,400. So that's your initial cost, your initial cash outflow. And then we have the cash flows for each of the 1 through 9 years based on whether or not we are evaluating a best case or worst case scenario. So our final step is to calculate net present value. Now you can do each one of these cash flows separately. Let me just kind of draw what we have, what we've actually done here. In this case, this would be a 9-year project with an initial cost of $788,400. And then in year one, it's just this operating cash flow of $1,504,386. This is just coming from down here. And you would have this same cash flow for years 1 through 9. So this is the operating cash flow that we just calculated, and this is the best case scenario. So then what you would do is calculate the net present value. The way that I always calculate net present value is I utilize my financial calculator. So this is where you need to remember to calculate net present value using the material from Chapter 9. When I click on the cash flow register, CF0 represents the initial cost or the initial cash outflow in year 0. In this case, it is negative $788,400. When I hit enter and push down, I see CO1. That is the cash flow for year 1. The cash flow in year 1 is $1,504,386. When I push enter and push down, F01 represents the frequency of that cash flow. That cash flow does not change for periods 1 through 9, so I can change that function to a 9. All we have there is an annuity for 9 years with a constant cash flow of $1,504,000. So I've actually input all of the cash flows from my timeline into my cash flow register. The next step is to tell my calculator what the discount rate is, so I hit NPV. I see an I there, and I type in my required rate of return, which in this case is 12%. Once again, given in the information, I type in I of 12%, and my NPV in this best case scenario is equal to $7,227,344.39. So best case scenario, my NPV would be a positive value, telling me that I would accept this project because it would increase the value of the company. So now let's do the same thing, except now I'm calculating the net present value here underneath the worst case scenario. So once again, if I were drawing my timeline, the only inputs that would change would be these operating cash flows that I've highlighted on the timeline. The operating cash flows for the worst case scenario are the negative $521,964. So clear my cash flow register. CF0 is still the initial cost of the project. In this case, the initial cost is still negative $788,400. And now CO1 represents that operating cash flow underneath the worst case scenario, which we said was negative $521,964. And once again, the frequency of this cash flow is a 9 because it occurs 9 times. I don't have any other cash flows to input. So then when I hit the I to input my discount rate is 12%, the required rate of return. So when I calculate NPV underneath the worst case scenario, I end up getting a net present value of a negative $3,569,554.57. So with us having a negative net present value underneath the worst case scenario, as a financial manager evaluating this project, you would look into these estimates and see what is the probability or what is really the possibility that these worst case scenario inputs could actually occur. If you feel that there is a high probability or a decent chance that those cash flows could actually turn out to be that way, which would result in a negative net present value, you might want to hold off on the project until you get more reliable or more firm estimates for all of your inputs. So these are 2 examples of a scenario analysis where you have what-if scenarios, best case, worst case, in addition to your best case or your base case scenario. So that's three scenarios as a financial manager that you can evaluate. The other type of information or the other type of scenario, or I shouldn't say scenario, the other type of analysis that companies will do is that sometimes they will do a sensitivity analysis where, for example, maybe they only change quantity and have a plus or minus range for just quantity, and they keep the other inputs the same, and they see what type of how sensitive your net present value is to changes in just quantity. So good luck with this week's homework. If you have any questions, please don't hesitate to reach out, and I'll talk to you all soon.